Hey everybody, Leah Slaughter. Hope you are having a wonderful Sunday evening. As you can hear, I've got a little bit of my voice back, not as much as I'd love to have to teach this to you today, but we've got this incredible series of getting started and how to build your investment portfolio. And so we didn't want to push this any longer, especially given the unique opportunity times that we are all in right now. An incredible time to be buying and investing in real estate and in our market. We're not going to talk too much about that today. If you haven't watched our wealth and rentals series, strongly recommend you do that. There are incredible things happening in our marketplace. We are in what I'm calling a pause right now. I personally have been buying as much real estate as I can get my hands on. We have 2 investment funds operating. We are all in on this time, and it's going to be ending before too long. I won't go into the intricacies as to why. Those of you that have been listening to me, following me on social media, you understand why we're talking about now being the time, and potentially one of the best times that we've seen in the last 3 to 4 years because of what's happening. And so today what we're going to be focusing on is really how you get started, what you need to be looking for, what type of model should you be following, what do you need to be doing to prepare to build an investment portfolio, or if you already have an investment portfolio, what is it going to take to get it to the next level? What should you be doing to get it to the next level? I'm not going to be taking questions today. I'm going to be asking as usual. Over the last few classes, we've been encouraging you to submit those questions to us, and then I will answer them live on social media. You can email us, or you can always send us a message on Facebook or Instagram or one of the many channels that we use. I am going to be showing you a lot of QR codes, not only at the beginning of the class today, but also at the end of the class. So I'm going to ask you to go ahead, if you're someone who uses QR codes, get out your camera on your phone. I'm going to give you a few dates and things that you're going to want to have open that you can register for. Of course, you can also go to our social media to see these dates, or you can go to our Eventbrite, or you can always email us info@slaughterinvesting.com. So this is a 4-part series of slaughtering investments. Today, we're going to be talking about the basics and getting started. On October 5th, we're going to be doing Leveraging 101. This is a big one. We're going to be talking about the loan products and processes that I used and that we use for our customers to build our portfolios. Next, on October 19th, we're going to be talking about the backbone of profitable investing. And this is really going to be focusing on the tenancy piece. How do we market? What type of tenants do we want? How do we write our leases? How do we enforce those leases? How do we make sure that property is ready for when it's time to exit under the 2 to 6 year model or cash out refinance? And then finally, our last webinar in the series will be November 2nd. And this is going to be over doubling your portfolio. So this is going to be over the actual doubling process of our 2 to 6 year model. All of this is brand new content, guys. And so really important. If you have questions, ask it. If there's things that you want to see covered, send it to me. That's what we're here for. You could scan any of these QR codes to register, or of course, you can also visit our website, slaughterinvesting.com. We have 2 real estate investment funds active right now. We have a live event talking about what a real estate investment fund is, what passive investing is, and talking about the opportunities in both these areas, and an update on our fund properties. This is a live event, October 10th. That's from 6 to 7:30, and that's at the Staybridge Suites, Plano Richardson. Would love to see you there, if for nothing else, and just to come shake my hand and say hello. We are doing our first virtual property bus tour on October 13th. We're going to be telling you all about our top areas and also showing you off-market property, the types of properties that we have used to build our portfolio and that we do for our clients every day. You do not have to want to be buying a property to attend this tour. If nothing else, you're going to learn a lot about these areas, about our new tech corridor, and why we are focusing so heavily on this investment model. This is a completely free live event. You can scan this QR code, or again, you can visit our website. We have 3 in-person bus tours upcoming. We have one on October 28th, the next one November 18th, and the last one of the year, December 8th. These run about 10 to 5. They visit our top markets, and it's $50 a person to attend. Again, it's a great way to get a hands-on experience of the types of properties we're doing, what areas we're doing, what's happening in these areas, the growth in the market, and where the potential is. And then our next Wealth and Rentals conference with new content is going to be on December 8th. We're going to have a little bit of the model that we talk about and a lot of market update. And so we'll be sending more information out about this as well. There'll be a property bus tour from 10 to 5, and then this conference will be from 5:30 to 7:30. We really hope to see everybody there. Our mission at Wealth and Rentals is free education. At the end of the day, we want to empower you to do what we have been doing for the last almost 17 years. Anyone can do this, guys. It doesn't take a lot of money. It doesn't take a lot of means. It doesn't take a lot of just intelligence in real estate in general. All it takes is the tenacity and the commitment and the consistency. And that is a lot of what we're going to be talking about today. What are the things that we did to make this happen? And how can you make this happen for yourself? I want to encourage you to continue to learn with us. Take advantage of the free education that we offer. We have our Wealth and Rentals podcast. You can go anywhere you are and pull this up, listen to it audio. And then, of course, we have our YouTube education channel as well. We're also posting market information, updates, opinions, thoughts, model information constantly on Facebook. So if you're not following me on Facebook, definitely go find me, Leah Slaughter, and follow me, because I'm posting, and this is me posting, guys. This isn't my team. This isn't my marketing department. This is me, and it's telling you what I'm doing and where we see our journey taking us in our investment journey. All of our events and things that we do are sent out by our text list. If you haven't already joined our text list, I encourage you to do so. You can also join our mailing list. Both work great. We have exclusive stuff that we send out to our texting list, and so definitely would love to see you join that as well. To join our mailing list, you can use this QR code here, but again, you can always visit the website to sign up there as well. Before I get started today, as always, I'm going to be using my best education guest experience of everything that I have done for my 17-year career, not only being a real estate investor, but being an operator in the real estate property management and investment sales industry. I am not a CPA. I am not a lender. I am not a tax professional. I'm not a cost segregation expert. I am not a lot of things. What I am is an investor and someone who wants to help you on your investment journey. Nothing that I'm going to tell you today is legal or financial advice. It's not tax advice. It is me giving you the tools to be able to educate yourself and arm yourself with information so that you can do for yourself what we have been doing for ourselves and our customers. We are always happy to refer you to professionals that are another tool in your toolbox, just like we are a tool. We have lots of people we work with who are a tool. And anyone who I refer you to is not someone that I get benefit from or kickback from. It is because they do a great job and they have helped me on my investment journey. But again, everything we're talking about today is my best guess, my best experience based on my real estate investment journey and how we believe our model is the best, the most resilient, and the easiest to model and recreate for others. So before I get started, I want to tell you where we started. For those of you who don't know me, we have a lot of newbies today. My husband and I started a real estate firm in 2006. The beginning of 2006, our early days were spent doing flat fee listings, investment sales, and property management. We did tons of short sales with AmeriQuest and Countrywide before they imploded. And because of our unique position and the volume that we were doing, the broker price opinions that we were doing, and hundreds of flat fee listings, we did see the crash coming. And so we built our model very early on, looking at where can we have people invest that are going to protect them against what's to come. Where did what's to come from, and how do we avoid that in the future with our model? And I'm proud to say that I've never had a client call me and say they lost money on a transaction. I've never had a client sell a property and not make money. And that is because of what our model is. And we're going to talk about that in our Wealth and Rentals today. That is not the goal. However, it's very, very important that whatever model you are going with, it has to be as resilient as possible. And that doesn't just mean the type of property you're buying. That means where you're buying, how you're buying, and what you're doing with it. We bought our first rental property in 2011. It was actually a personal home. We adopted one child, went back to adopt two more. We needed more space. We turned that property into a rental because we knew the market was going to come at a much higher increase than where it was at that point in time. So in 2013, we were sitting there running our successful business, focusing on making money, focusing on helping these kids that we'd adopted from CPS and making a lot of people a lot of money. So 2017, Michael and I are on our way back from the casino one night. That's where we used to go to escape because we never had cell phone service. And if you're in property management, you know the goal is to get out of cell phone service when you want to turn it off. And I said, you know what? All this money that we spend on recreation, if we pump that into rentals, we should be doing the same thing our clients are and building a future for us that is outside of just our company, not looking to exit our company. And I'm going to focus on this a lot today. A lot of people start investing in real estate and the only thing they think of is, how do I quit my job? That is not your goal. And I'm going to talk to you about why. Your goal is to have secondary income. That way, when the time comes and you want to do something with that secondary income, you are in an empowered position to be able to do so. So we started with 2 rentals in Sherman, 1 new, 1 pre-owned recent build, and 2 new construction homes in Greenville. A few months later, we purchased and renovated a 6-unit apartment in Wiley. And ever since then, we have been selling and continually buying and selling with 1031 exchanges and built our $40 million portfolio. And that is what we have been doing. Now, it all starts with getting your ducks in a row. Really cute graphic, isn't it? But at the end of the day, this is what everything in life is about. It's getting prepared, doing research, making a plan, and executing that plan. Sometimes we don't have the ability to do that. Things happen in life where we can't plan and we can't execute and we can't exactly be 5 steps ahead or 6 steps ahead of where we want to be. The one benefit of real estate investing is you can always be prepared. You can always have a plan. You can always have a contingency. And one of the things I focus on heavily in our wealth and rental side is why single family. Talk a little bit about that today. But at the end of the day, getting your ducks in a row also speaks to resiliency, exit strategies, different ways to make money, all the diversification tricks we talk about. It's not just getting prepared to buy, it's how you are preparing the entire financial journey for the rest of your life. Fear is what we see keep most people on the sidelines. Fear is debilitating. And when it comes to real estate investing, if it's not something that is second nature to you, that's going to be your biggest obstacle to overcome. If you have not yet bought your first property, I promise you the first one is the hardest. It's the mental block that we put in place to stop us to create fear of something that we have not yet experienced, something that we don't feel we understand. Fear and failure to act, what I see with our customers and people who come to me for guidance and mentorship, usually comes from one of 7 things: a lack of knowledge, a failure to understand the knowledge that we're being given, self-doubt, indecisive tendencies. This is a big one. You think you know what you want to do, you start to act on it, you have second thoughts, you start trying to talk yourself out of it. Indecisiveness is a killer in the real estate investment world. A yo-yo mentality. One day you're all in, one day you're all out. You make a plan, you start to execute it, and then you flip-flop the other way. I have clients that do this. And it's just a very, very hard pattern to overcome. But once you overcome it, it's very easy to be consistent. Complacency. I was in a complacency position up until 2017 when on the way home from the casino, I had an epiphany. Complacency is really, really easy to get into when you're not worried about money, when you're not focused on having to have more money. Sometimes when we're driven because of money, we actually are going to make better financial choices than when we're in a complacent or happy or comfortable position. And probably the biggest of which, the lack of instant results or gratification. We'll talk about that a little bit more in a second. Where people struggle, especially when it comes to understanding and really comprehending what they're doing and how they're going to be doing it. It's what model you're going to use, what market you're going to buy in, what market is right to buy in: linear markets, appreciating markets, cash flowing markets, the pros and cons of real estate investing and the different types of real estate investing, the risks associated, how you're going to come up with the money, where the money is going to come from to keep going. Big, big piece of our 2 to 6 year model and why we do it the way we do it, so that we don't have access to infinite money. The average investor does not have access to infinite money. It's taking what we start with that we have to use as far as we can, because that is the biggest pot you're probably ever going to have access to. The budgeting of real estate investing, ownership, credit. This is a big one. We're going to focus on that a lot today. Lending. That's going to be the focus of our next class. Time, having the time to learn, having the time to monitor, having the time to manage, having the time to think about it. Takes up middle space too. Priorities. Is investing in real estate and doing this your priority? Are you too busy with your kids or with your job or with your health? Lack of motivation. This goes back to complacency. And then finally, the long-term strategy. A lot of people focus on the here and now, but they forget to focus on the future. Remember, this is a long-term strategy. This is not a get rich overnight. Real estate wealth building is slow. It is consistent. You must methodically think it out. You must methodically execute it. It's much, much easier than it seems. And it's easiest if you are consistent. My biggest caution for you is don't fall for the get rich quick schemes. If it sounds too good to be true, it probably is. Every week, a new wholesaler reaches out to me, and I won't name any companies, but it's the same couple They market to them, they hire them, they promise them these massive, massive incomes. And then what happens? A few weeks later, a few months later, they're gone. They're out of real estate, or they go get their license, or they go do something else. It's the same thing with the lottery. It's the same thing with gambling. If it sounds too good to be true, it probably is. And that's not to say that there's not incredible returns in real estate, but generally the better the quote return, and I use that very loosely. Linear markets have a really, really bad problem with this. On paper, their cash flow looks better sometimes. But when you look at the policies, the way that tenant move-outs are handled, lack of evictions, older homes, repair costs, it gets really bad quickly. And when you're not building equity because of appreciation, you don't have a dime to spare. The better the return generally, the higher the risk. So it all boils down to overcoming fear. Don't get caught up in the news. This is a big one right now. Remember that most of your experts pay to be on programs. They pay to be on the news, or they're the ones that answer the phone that they can find to answer a quick local news article or media question. I cannot emphasize this enough. Just because someone is in front of you on social media or TV, it does not mean they are successful. It does not mean they have money. It does not mean they are doing this, and it does not mean they know what they are doing. I want to remind you, we talk about this a lot in wealth and rentals. There is no nationwide market. There are only local markets. It is just about taking that first step. And I want you to keep reminding yourself that whether you've been sitting on the same property for 7 years and you're afraid to go cash it out or sell it, whether you haven't bought your first property, it is just about taking that first step on whatever journey you are on. Probably the most important piece of getting started is focusing on how you qualify and how you're going to make it happen. And that boils down to debt and qualifications. And a lot of people really don't understand how real estate lending and debt works. Your credit is probably the most important piece of this, especially today, because coming out of the last crash, coming into this tightening that has happened in the lending world since interest rates went up, credit is extremely important. 680 is no longer a prime score. Your credit beyond the score is going to be used in multiple ways when buying investment property. Number one, having a high enough credit score to qualify for a program, or that credit score is going to determine the program terms you qualify for and even the program you qualify for. We're going to focus on this next week. Confirming your ability to pay based on payment history and debts. This was a big one coming out of the crash when so many people were doing short sales and foreclosures. They're going to look at your ability to pay and your payment history to decide, are you able to pay this mortgage? Do you show a credit history of being willing to pay this mortgage no matter what? Even LLC financing requires review of your personal credit most of the time. The only exception to this is sometimes DSCR. Now, I want you to remember, new loans are also going to go on your credit if you're putting it in your personal name, whether it's Fannie Mae or not. Even our direct bank products, even though it's not Fannie Mae, they're still going to put it on your credit, and that can affect your score too. The more credit you have, the more experience you have, the less it's going to affect you. But if you're someone that is not using your credit, that's going to affect you a lot. So early in my investment journey, I was using my credit all the time, using a credit card, paying it off immediately, taking a no interest on a TV or whatever, paying it off slowly. Obviously, I don't do that anymore. But back in the beginning, I was doing that a lot because I knew the properties hitting my credit and the pulls were going to affect my score. And it's very important to keep your score as high as you can. Now, there's a lot of people out there that talk about debt and how bad debt is. And of course, I don't look at real estate investment debt as the same type of debt as bad debt. So the question becomes, is all debt bad? There is good debt. Something that you believe is going to go up in value throughout time, usually is going to have a lower interest rate and increase your credit history over time. It might affect it negatively when it first hits, but eventually it's going to increase your credit. Examples of this are real estate loans and student loans sometimes. These are the types of things that we are doing in our name to build our future. Now, bad debt, and this is where people get lost. This is where people make big mistakes. There's usually a better way. The most common we see is credit card debt. Always, always, always consolidate your credit card debt into a personal loan. You want a longer amortization, a lower interest rate. Right now, this is exceptionally important. I cannot tell you how many people I mentor that come to me. They have the means and the ability to put that credit card debt on a personal loan, and they had no idea that is even an option. Credit card debt only makes sense at 0% interest promos, but be mindful of your credit score and credit usage, because if that percentage gets high, you have a $5,000 card and you put a $4,000 TV on there, your credit score is going to be affected. When they're looking at your credit, though, they're only looking at what the minimum payment is. And so that's important to keep in mind as well. The longer the amortization, the lower the monthly payment. If you need guidance on this, I'm going to be doing a class upcoming on credit card debt to personal loans and how to get your credit back where it needs to be. Not going to focus too much on that today, but if this is the situation that you are in and you have a lot of credit card debt and that's what's holding you back, get it into a personal loan. There's usually a better way than a credit card. And of course, payday loans, those types of things, that's a big no-no. That's just predatory lending. Way too expensive. You'll never get ahead. Your debt to income ratio is one of the first things that a lender is going to look at. When you're buying an investment property, different programs are going to be looking for different debt to income ratios. So let's talk about what a debt to income or a DTI is. They're going to look at your monthly expenses. They're going to divide that into your pre-tax income, and that's going to be your debt to income ratio. So say your monthly expenses are $2,000 a month and you make $8,000 a month. That would be a 20% debt to income ratio. That would be a good debt to income ratio. Your debt to income is how lenders are going to measure your ability to pay that monthly mortgage on the debt that you are looking to borrow. So you are asking a bank to lend you money, and they are going to be looking at affordability for you. And the DTI is how they do that. So first step is going to be, do you pay your debts on time? Second step is going to be, how much debt can we lend you? Again, as I mentioned, each program has different DTI limitations. The most common that we're going to be talking about today is Fannie Mae. Right now, Fannie Mae is generally the best choice. It's a 30-year fixed, but that really doesn't matter. No one's going to be sitting in the interest rates that are being written right now. What matters is the 30-year amortization. Fannie Mae typically maxes at a 50% DTI. So going back to my example, if you make $8,000 a month, your debts cannot exceed $4,000 a month. However, it can be lower based on your credit profile, your assets, and other things as determined by automated underwriting. And that's called desktop underwriter, or if you're doing Freddie Mac, that's LP. So that's their proprietary systems they use to decide. They plug it in and it's automated and it tells them what DTI they can look for. The vacancy factor is deducted from rental income. And what that means is each property that you write as a rental, they're going to take 25% of the rent away and call it a vacancy factor. So if you are buying a property that rents at $1,200 a month, they're only going to give you credit for $900 of that towards your mortgage. This is why it is so important that you are buying properties that cash flow. One of many reasons why that's important. Your DTI needs room to cover mortgages at a 25% vacancy factor on every purchase. Banks are also going to require you to have reserves or money left in the bank after your down payment and closing costs. And the more properties that you own, the more that you're going to need in reserves. When talking about Fannie Mae, they're going to want 2% of the aggregate principal balance at that point in time if the borrower has only 1 to 4 financed properties. Once you get to 5 to 6 properties, they're going to want 4% of the principal balance at that moment. And then once you get to 7 properties, they're going to want 6% of the aggregate principal balance. So let me give you an example on that. Let's say that you are buying a $220,000 home and you put 20% down. So you have a mortgage for $176,000. At 4%, that means that they're going to want about a $7,000 reserve for each property you own sitting in the bank. Now, personally, I don't think that's enough. So let me tell you what I recommend and what I coach people in. I think you should have 6 months of payments as reserve in your bank account per property. And payments means taxes and insurance and mortgage. You also, over and above that, should have reserves for your own personal expenses and future unexpected needs. So if you have $50,000 in the bank, you should not be putting $45,000 down on a down payment. The upfront costs when we're looking at purchasing a property, most loan programs require 20% down minimum. We did have days where people were doing 15% down when rates were so low and there was PI and all sorts of other things. But the bottom line is you should never be putting less than 20% down unless you are capturing equity, meaning that you're buying a property that has equity built in too. In the current rate climate, though, you should expect to put 25 to 30% down to achieve good cash flow. Closing costs are going to vary based on the type of product. We're going to talk about this a lot more next week. We're going to talk about the different types of products and the cost of each product. Again, it's very important not to use all your cash. The lender's not going to let you, but you need to make sure that you keep enough aside. And if you are doing rehabs, and I'm going to say this twice, you need a significant nest egg for a rainy day. If you are doing rehabs, you must keep significant cash reserves. A lot of people think that doing rehab properties is the best place to get started. It absolutely is not, unless you are cash heavy. Now, one of the things people ask me a lot is, well, should I buy in my personal name or should I buy in an LLC? There are big product differences in the types of lending products that you can get, especially as it comes to amortization, balloon payments, and a fixed period. Fannie Mae requires your personal name to close on the property, but you can deed it over to your LLC after closing without a problem now. There are asset protection considerations between a personal name and an LLC. But generally, when you are just getting started, unless you have significant assets to protect, putting it in your personal name with Fannie Mae is going to be your best option. Again, you can always transfer it after closing. We have people do that all the time. One disadvantage of putting it in your personal name is it is going to hit your personal credit. But keep in mind, most LLC financing for new acquisitions is 25-year amortization, and it's going to significantly affect your cash flow. You're still going to get the profit. It's still going to pay principal down. That money's not disappearing. It's just going to pay down your loan. But your goal is cash flow. That is your goal. Leveraging allows you to grow your portfolio as fast as possible with our model. And our model doesn't just work in North Texas. It works anywhere you have a cash flowing and depreciating market with a housing shortage and a major employment boom happening. So when we have all these employment companies coming in, jobs moving here, that's the piece that you want to see paired with the housing shortage, a cash flowing market, and depreciation. So how does your income help you? This goes back to where I started. Your goal is not just to quit your job. Don't call me and tell me that my goal is to quit my job. That's not your goal. Your goal is to have the financial security to be able to quit your job when you're ready. Remember that your job is what lets you qualify for non-DSCR loans. Your job is what lets you build the portfolio. That passive income is in addition to it, and eventually it's going to become active income. Eventually, that's going to become your job. That's the goal. But right now, that job you are in is what's allowing you to do this model and build your wealth. Don't get caught up on just focusing on retiring as soon as possible. The goal is not just to have 100% of living expenses covered. What do you think is happening to people that set out how much they needed to retire 5 years ago and they retired? What do you think is happening to them right now with the cost of living, the cost of goods, the cost of gas? Just covering 100% of your living expenses is not near enough, and certainly not if you're younger. A lot of the people that we retire are young. Where do you think the cost of living is going to be in 20, 30, 40 years? And now so many Americans are living to 90 to 100. Retirement's not just 10, 20 years anymore. You have to think bigger. So let's start with assessing properties, because this is where thinking bigger starts. Because we have to understand how to look at properties, how to decide what properties work, and how they're going to make us money. So those of you that have attended our other classes, you already know how to do this. How do we calculate a cash-on-cash return? We look at yearly net income. So that's what all your monthly rental is, times 12, divided by the amount of equity that you have. Notice I didn't say the amount of your down payment. I said equity, because any equity you have sitting in that property is cash that you could be using. It's very simple. So if your property is making you, let's say $200 a month. So $200 a month times 12 months is $2,400 a year. And let's say that you have $100,000 equity in that property. You put 20% down, it's gone up another 20%. Have a little bit extra in there for principal pay down using round numbers. That would be a 2.4% cash on cash return. Pretty scary, right? But that same property at $200 a month times 12 months, that'd be $2,400 for that year. By the, let's say, original $40,000 that you put down, your cash on cash return used to be 6%. So this goes back to what we teach in wealth and rentals, that the longer you hold that property, the more equity you have, the worse your return is going to get. And this is why that 2 to 6 year model is so important. Not only are we challenging you to use that equity to continue going and build more wealth for yourself and more cash flow and more equity growing, but also to maximize your returns. So let's talk about how real estate makes you money. Let's talk about how you're going to assess the money that these properties are going to make you. First, we have rent income. That's the obvious. Second, we have appreciation. That's the price going up on this property, the value increasing. The third is principal pay down. That's how much money are you paying towards your loan every single month in principal out of the monthly payment that you make. And then finally, the tax benefits. What are the tax benefits of owning that property? What is it going to reduce that you owe in taxes, and what is the value of that? Let's start with cash flow. I'm going to say this loud. You should only own rentals that have positive cash flow. I hear so many people out there right now talking about buying for no cash flow. Do not. Don't do it. The cash flow is the most important thing. It does not matter if you're living on the cash flow. I hate when clients tell me that. Well, I don't need the cash flow right now. I'm not looking to retire right now. I just want to buy in the best area. No. You want to buy in the best area and have positive cash flow. The higher the interest rate, the lower the cash flow, and the lower the cash on cash return. So the more interest rates go up, the higher that payment's going to be, and that is eating into your profit. So consider a $250,000 home with 25% down. At 8% interest, your principal and interest payment is just over $1,375. At 6% interest, your principal and interest payment is $1,124. That's a difference of almost $251 a month. That is more than double your cash flow on most properties right now. That $251 approximate per month, divided into your $62,000 down payment on this property, that's that $250 with 25% down, means that the interest rate dropping from 8 to 6, which we're not up to 8 yet, and I think we're going to be back to 6 before too long, that increases your cash on cash return by almost 5%. So that 5% cash on cash return that you're buying today could be 10% on that same property in a year or two when you refinance, when rates drop. And this is the power of the pause and the ability right now to build massive wealth, because you can buy properties before prices go back up when rates come down. You can always refinance that property. You cannot manufacture lower prices again. And for all those people thinking that prices were going to drop and we were heading into a recession, I think you were wrong. The strong markets are getting stronger. My top market, Grayson County, I want to show you what it's doing right now. So this is August 2023 numbers, so no funny business here. I'm not showing you last year. I'm not showing you spring. This is last month's ending numbers. Our median list price is up to $337 and some change. The list price of homes in Grayson County has gone up over 12% since last year. That means, theoretically, if you owned a home, you gained about $37,000 equity last year. $37,000 equity on one home. So someone like me who owns hundreds, you can imagine what that looks like. Our clients who own 10 or 20 in their journey, what that looks like. You sitting on your one with all that equity that you could have turned into 3, what would that look like for you? In the right market and the right housing climate, appreciation will max or exceed your cash flow, especially when you buy in the right area and the right model under the 2 to 6 year model. On average, most of the areas that I do are seeing and expected to have about 9% appreciation this year. As I just showed you, many of them are seeing more than that. On that same $250,000 house, that means a $22,500 increase in value in 1 year. To put that into perspective, that amount of money is a 36% return, cash on cash return on your down payment of that $62,475. So just by having bought that house, you made 36% of your money back in 1 year. In less than 3 years at that rate, you've gained more equity than you put into the property, and your return is now infinite. What that means is you now officially have no money in that deal after you sell it or you cash out. But as long as that equity is sitting in that deal, it has to be calculated. 95% of my portfolio or more is infinite return. Think about that for a minute. That means 95% of what I own is making me money on no money in. That is how, and that is the power of the 2 to 6 year model. And this is the process that you have to be looking at when you are getting started and you are scoping properties. And getting started works when you own a property you've been sitting in too long too, right? Because this is what we have to be looking at constantly as investors. This is not a buy one and you're done and you sit on it for 20 years. That is not how successful real estate investing works. Appreciation historically adds up to a lot more than cash flow. And this is why it's important to own as many as possible, why to move as quickly as possible. Next class, we're going to teach you those leveraging strategies. And today we're teaching you those purchasing strategies. So let me put my money where my mouth is. Let's look at historical appreciation in housing. Since 1942, we are overall up over 436%. Just since the year 2000, we're up 119%. Since 2010, we're up 74%, including 2 down years. Only 6 out of the last 81 years were down. 6 out of 81 years. And all but 2 of those years were during the recession that we caused because of lending practices. We as a country, we as a financial institution, we caused it. Just because values have gone up does not mean they have to come down. A lot of people went viral talking about the market crash this year. A lot of people on the news paid to be there, talk about the market crash this year. What's happened the last few years, it's not abnormal. From 43 to 47, values went up almost 120%, and they kept rising for 40 more years without a single drop. And then from 74 to 79, values went up 93%, and then they continued to rise for another 10 years before they dropped only 1% in 1990. And then they rose for 14 more years. Again, the only time real estate truly suffered was during the crash, the end of 07, and that was a manufactured crisis. Housing inventory was a huge cause of the crash in 07 to 12 because of 4 million properties on the market compared to less than 1 million today. As it stands today, we are in the greatest housing shortage of our lifetime, and it is a crisis, and very few people are talking about it. The next way that real estate makes us money is principal paydown. So on that same $250,000 home, every year you own the home, you're paying down more in principal and you're lowering your balance owed, meaning you're increasing your equity, meaning you're dropping your cash on cash return. So the same property, if we started a loan January 1st, 2024, that first year you would pay over $2,300 just in principal. So that property that's cash flowing $200 a month, it's actually cash flowing almost $400 a month, even with interest rates where they are. Just so happens $200 a month of it is going into your loan. And you notice it goes up very quickly. Every year you own it, you're paying more and more to principal. So that first year you earned an additional $2,300 in cash flow. That's another almost 3.7% cash on cash return. Adds up quickly. So what does that mean you made overall in year one? Let's talk about that. So you put down $62,475 for your down payment on that $250,000 home. You made just over $2,300 in principal paydown. You made, let's assume, $22,500 in appreciation. You made, assuming a negligible 4% cash on cash return because of high interest rates, which in reality you would have made more than that had you bought last year. But let's look at where rates are today. About 4%, 5% cash on cash return. You made another $24.99 in rent income. That means your total profit for year one on that one property is $27,301.52, or more than a 43% cash on cash return in 1 year. This is the power of what we are talking about. Now, what about when rates drop and your return is now 9% cash on cash? More than likely, even more than that, but let's use conservative numbers here, 9% cash on cash. So you put down your $62,475, you made $23,0252 in principal pay down. You made $22,500 in appreciation. The only thing that changed is your rent income because you refinanced. You made $5,600 in rent income in 1 year now. Your total profit year one in this revised example, or maybe it's year two or year three, is now almost a 49% cash on cash return. And in reality, the appreciation in the years where rates go down, we're not looking at 9% appreciation. Those of you who were in the market with me, when I was telling you, please buy, it's 20 to 30% in a year. Let's scale back the model. Let's assume appreciation drops to 5%. Let's assume it goes down, or maybe the market that you're in, you're not appreciating high like North Texas says. So you put $62,475 down for your down payment, made again $23,0252 in principal payment. You made about $11,250 in appreciation in a year, and you made, assuming that low 4% cash on cash return, $24.99 in rent income. Still in the revised example, you made over $16,000 in that year. Your cash on cash return is over 25%. There is no greater investment for so many reasons than real estate. And let's not forget our forgotten income source that so many people don't think about, the tax benefits of owning real estate. Real estate is depreciated to reduce your tax liability, and depending on your status on your tax return, and specifically if you become a real estate investor, there are so many ways even above and beyond regular straight line depreciation too. But let's assume a 27.5-year life on a single family home, that $250,000 building value, and you could throw whatever number you want out there. Say the building's worth 200,000 or 150 or whatever your lot's worth. Doesn't really matter. The bottom line is you are making a lot of money in depreciation. A 27.5-year life on a single family home where the building value is 250, if your basis is 250, that's over $9,000 1 year depreciation. So consider what your tax bracket is, and that amount of depreciation, that almost equals your cash flow. And cost segregation, if you can get yourself to real estate investor status, which that is our #1 goal for anyone who invests with us, it is a tool to accelerate the depreciation schedule on your real estate. Somewhere between 20 and 40% of the parts of a property fall into categories that you can write off faster than what it is on a 27.5-year straight line depreciation. That study, that cost segregation study, removes those items out and separates them to items that can be depreciated quicker over a 5, 7, or 15-year life. On my properties, about 30% cost segregation is what I saw. So on a $250,000 valuation, I got to write off $60,000 my first year at 80%. So that's what I'm cost segregating right now. So that includes the step down cost segregation status that we are seeing right now. This is incredible inflation protection, incredible, because the money that you are taking right now is worth more today than it is later. The value of the dollar is continually plummeting. Plus, it's making you more money in the meantime. Even if you just sit it in your bank account, my bank account's earning 5% right now. If you're not earning good money on your money, that is one of the first things you need to go do, because banks are paying crazy interest rates on cash sitting in a regular account right now. Now, let's talk about how to pick a property and how to pick a model. Of course, the most important thing is your market selection. Do you need to invest locally? That's the #1 question people ask me. But can I really invest somewhere else? It all comes down to your team. Again, local markets are where you have to be doing your research. Hyper-local research is the first step to any investment journey. So what are we looking for in a market? You've decided, you've got your team in place. We're going to talk about what your team looks like. One of the things we're going to be focusing on in the property management webinar, #3, is going to be talking about how you're going to make sure you keep the right team in place and how you prepare. But the first and most important step is finding that market and finding that property. So what are we looking for in a market? What is going to tell us that we are ready to invest because this area is poised to have the best potential of anything else that we could look for? First and foremost, you need a large market. Large market means resiliency. It means diversification. Large market means different areas to diversify within. It means large employers. It means it's on the map. You need a large market. Don't go find some 1,000-person town in the middle of nowhere that's not part of an MSA and go buy there. You need an ability to grow in the suburbs because the jobs are there. You do not want to buy in a city or a market that is inner city driven. Those are your markets like Chicago, LA, San Francisco, New York. That is not a stable, non-bubbled investment model. You need highways that connect the outer areas to each other. That way people can live and work in different areas so you're not landlocked, so that people are not going to want to continue to move to other places outside of where they are because of a bad infrastructure problem, like what we see happening in California right now. It needs to be undervalued based on its market size. You need diversity of industry, very important. If everything in that area is car manufacturing or oil and gas dependent, when that one sector suffers and every sector suffers eventually, that area will collapse. You need an international airport with expansions happening or happened. You need low crime rates in the area you're looking in. Very important. Very, very, very important. You need employment growth. This is huge. You need an area that has to continue to grow. You don't want stagnation. So not just employment growth, but you need population growth. And I'm not just talking from births. You need a housing shortage. This is key, especially in apartments. You want to buy in an area where they are not flooding it with apartments. You want a low cost of living. This is a tall order, y'all. There's only one market in my mind, maybe two I can think of that really tick every one of these boxes. And then finally, you want appreciation and cash flow. I do not and will not invest in a linear market, period. Just won't do it. So we have two different types of markets that we look at, a boom market and a pre-boom market. And this is where I invest everything that I do, and this is where we put all of our investors. So a pre-boom market has a few things that are very, very key to it. A lack of apartments is number one, especially apartments built in the last 20 years. Minimal anchor stores. That means you're going to see Walmarts, Dollar Generals, gas stations, those types of things, but you're not going to see a lot of big infrastructure. It's going to be located close to a highway, near a busy area, typically the next county out or the next city out from a busy area. You want to see some extended stay type hotels, 2 to 3 star hotels. That's Holiday Inns, Microtels, Home 2 Suites, Marriott, Little Ones, those types of things. You want to see manufacturing jobs. Most of these little areas, most of the jobs they have are going to be manufacturing, blue collar work. And you want those employers expanding. And you want to be 20 minutes max to employment centers. When we get to a boom market, we get to an area that has its own employment center. So that's one of the key differences. You want a lack of apartments still. You want to make sure there's open land between it and the next developed suburb. You want massive population growth. It's going to have, again, its own employment center, but also be drivable to others. You want to have infrastructure growth, and you want to have rent growth. And most importantly, home price appreciation, because we've already established that that is a larger return than cash flow. You want to pick the areas that are experiencing higher than normal job growth and lacking the needed infrastructure. If I buy smack in the middle of LA, they have enough grocery stores, they have enough gas stations, they have enough infrastructure that if the market starts to fall, they can stop development. The areas that I invest in, they have so much relocation and they have such a lack of infrastructure that they are going to be building and expanding and growing for years to come, no matter what the market is doing. And that is the strength of buying in an area with a massive population boom. And I want to remind you, single family is your lowest risk. It is your best investment vehicle. You have direct control over the asset, multiple purchase and exit strategies. They're easy to leverage, low exposure per property because you can leverage them. It's easy to diversify geographically because there's tons of options. And there's more ways to do single family investments. So then that question becomes, well, do I want a new or a pre-owned home? Because this is one of the first things I talk about with investors. I always recommend people start with new construction, always. Why? It's a more passive and consistent approach to individual ownership. It is a better way to get the same amount of money coming in every single month as closely and as consistently as possible than going with the pre-owned home. It's often going to target these areas that we're talking about, these boom and pre-boom markets, because if you're investing in pre-owned older homes in these pre-boom and boom markets, they often need a lot of work, and that's really high risk. You want to be targeting these developing areas with the new infrastructure and heightened growth happening, along with all this person and employment relocation happening, because that is what's going to create that push to the area and naturally increase not only the desirability of the area, but naturally the prices of the area. And I'm not talking through appreciation. I'm not talking a whole area appreciating because that market is growing. I'm talking about that particular area becoming more desirable, more luxurious, more renovated, more new development and shops and parks, where the price of the area goes up naturally. And you can buy at the beginning of development before prices skyrocket. This is key. You want to get in before it's overinflated. When we look at repairs and maintenance expenses, the benefits of new construction is everything is new. You have new systems for lower cost of maintenance and ownership, and that includes your foundation. And over and above that, the builder's going to warranty a lot of items. And you can even get affordable extended home warranty or third-party service contract protection options. So when I work with builders, we require them in most cases to do what's called a 1-2-10 warranty. I'll show you what that looks like in a moment. You're also going to have manufacturer's warranties. And then above that, If you do a brand new home, you can put a 4-year home warranty policy in place for only $1,000 with Fidelity. So this is an example of a typical builder warranty. So this is a 1 to 10. And so you can see you have a 1-year workmanship. Think of it like more bumper to bumper, a 2-year systems, and then 10-year structural. So if you're following a model and you're only going to own it 2 to 6 years, by the time you have this and you have that home warranty, a lot of what you're doing is covered. And because you've got a new home, when we talk on the tenant side, it's a lot easier to hold tenants accountable when everything is brand new. Home warranties are an important tool, whether you're buying a new or a pre-owned home. Think of it as a discount plan, not insurance. The cost is about $500 a year on a typical pre-owned home. I'm using Choice right now. It's about $1,455, or their highest level plan is $1,490 for about 35 months. That's what I put on my properties. New construction options, again, they cover years 2 to 5 with Fidelity, so 2 different companies. Co-payments are typically somewhere between $60 and $75, and it's going to cover most major systems within your home. It's a great way to have more consistent income, again, going with a home warranty, because you're going to have that consistency of expectation of expense better than if you're 100% on the hook. I recommend it on all properties, but especially pre-owned acquisitions, even when they're renovated. Now let's talk about pre-owned properties for a minute, because there is a place for this in the investment journey, a big place for it in the investment journey, just not day one. Especially not if you are an absent landlord, meaning that you are not living in the area where you are investing. Newer homes and neighborhoods are just built differently. They're engineered differently. The slabs are done differently. The framing is different. The types of windows, the roofing, everything is done differently. I can tell you from experience that pier and beam slabs tend to have more expenses. They tend to move more. They're more susceptible. Just because it's remodeled doesn't make it new. If I could make one thing my logo about, or my motto about all these people out there quoting the get rich quick by renovating and flipping, this would be it. Just because it's remodeled doesn't make it new. Ownership and tenant costs are lower on newer homes. And I'm not just talking brand new, I'm just talking something built this century. Insurance costs are lower, utilities costs are lower, maintenance costs are generally lower. So from an ownership perspective, you can, and I do it all the time, I renovate a house completely. That doesn't mean there's no expense after. In fact, my pre-owned homes are far more expensive to maintain than my new ones. And then of course, the stigma of pre-owned homes. It's harder to get them to look modern. It's harder to get them to, where people are looking at it, not thinking that it's going to be less efficient than a newer home. Often the neighborhoods might not be as clean unless there's tons of revitalization going in there. So you just have to be careful where you go. If you're buying pre-owned homes in a very expensive area, you're less likely to have a lot of those homes remodeling than like the areas that I buy where everything's getting remodeled. And then the question becomes, well, do I want to be a passive investor or do I want to be an active investor? So when we look at passive investing, we're talking real estate investment funds, syndications, REITs, things where you put money in and you don't have to do anything. You just get distributions, and then at the end, you get an equity piece. So you have limited control, but virtually no involvement or time. That often allows for diversification across different types of assets or different assets. Your investment is a liquid, meaning if you need out, you often can't get out, and your credit is not used. So if you have credit problems, or you don't use your credit, or you don't want to have to go get loans, passive investing is a great thing. But typically you have to be an accredited investor, meaning you have to have an income over 200 a year, 300 for a couple. You have to have over $1 million in net assets, and that can't include your personal house. Now you could do a cash out on your personal home or HELOC, pull the cash, let it season. There's ways to get there, but that $1 million threshold is a lot for a lot of our clients and people we work with because they're just getting started. The benefits of active is you can own your properties 100%. If you do the right model, the right team, the right area, you could still have low involvement. Again, going back to new construction, that's what gives you that passive feel, especially if the property is being professionally managed. So again, property management is key to any successful investment. That's going to be an entire class all by itself, number 3. You can exit at any time because you were in control of the asset, and it is a liquid investment. You can go sell it, not as liquid as cash in the bank, but you can liquidate it. And credit is used for financing, so it's important that you're able to keep your good credit and that you can qualify not only from a credit perspective, but a DTI perspective on your credit. Now, I typically focus on infill properties. So what that means is you're not buying one new construction or recent construction home in the middle of 100 identical new construction homes. You're buying one home that is new or remodeled, and it's in the middle of 100 other houses where everything looks different because they're all different ages and all different sizes and all different, construction types and different builders. And what I find with that is that tenants stay longer. They create more of an identity with the home because it's unique, and they lease better. So we actually see higher rent rates often in our infill properties than we do in homes in the middle of a neighborhood. Really interesting phenomenon. But This is why I love infill property, in addition to the fact that there's a lot of other benefits. So new construction and remodeling is heightened in infill areas, and these areas tend to grow at a faster rate in terms of price growth. Property tax benefits, if you're buying new construction or infill property, it's much harder for the tax assessor to value because, again, they don't have 100 identical neighbors to compare against. So often we see property tax bills be much lower on infill properties. There's no HOA in infill properties. We love that. Often it's reduced pricing over those big planned communities. Lots of redevelopment and money pumping into these areas. I'll also add in here that they're often closer to the downtown and shopping and really kind of unique artsy district. And so that's a big push where people can walk to these things. They're often undervalued. You often are going to get a better deal, and they have a heightened ability to go up in value because they aren't worth what those neighborhoods are yet, at least on paper anyway. And then again, I want to repeat this, natural price growth because of beautification, desirability, and draw increase to the area, getting nicer, bigger, better infrastructure, better homes, makes it more desirable, puts it on the map. This is exactly what we've seen happen in Sherman Denison, for example. Even Greenville, for those of you that were looking at Greenville 6, 7, 8 years ago, totally different city than what it is today. So how do you make all this successful? You build your team. This is huge. Your team is going to be the backbone of everything you do. They're going to be the ones that you call with questions, the ones you call with problems, the ones that you find information from, the ones that are going to educate you, support you, guide you. And the bigger you get, the more you're going to need that guidance. You think that you're going to know it all, but I promise you, the more that you do, the more you're going to need that team. So your agent, your broker, your wholesaler, where you're going to source your property from, your builder, your seller, where you're going to lend that property through, your lender, your bank, how you're going to make sure that property fits what you need and it's in right condition, that it's not a disaster waiting to happen. That's your home inspector, your repair vendor, that you make sure that it stays occupied and that it's being taken care of during the tenancy for when you need to sell, and that you're not getting 3 a.m. calls. That's your property manager. Also, your bookkeeping, your 1099s, your eviction processes, your collection processes, your make ready processes. I could go on and on and on, but again, there's going to be a whole class about why you need a property manager. Your attorney, your CPA, your cost segregation provider, your home warranty company. That is building your team. But your team is also the tools that you use. I use tax records. I go to the CAD, the Central Appraisal District. I can verify square footages. I can look at plat maps. I can see year built. I can see who owns it. I can see the history of how long they've owned it. I use FEMA flood maps to see if the property is in a floodplain because I won't buy or sell in floodplains. Zillow, look at what they think the value is. I love Rocket Homes. I think it's an awesome site with great information, and their charting's updated every single month, and they do great comparisons. So Rocket Homes I use a lot. Realtor.com, the MLS IDX, that's what feeds from our MLS, other MLSs as well. There's some litigation going on about this, but for right now, that's where it comes from. Word of mouth, this is huge. Your buddy knows a house down the street from him is selling. Your tenant knows that the neighbor 3 doors down is selling. Facebook groups, big for marketing, big for purchasing. If you're doing Airbnbs and VRBOs, which I don't recommend, it's a great place to get furnishings. And mailing lists. But then the question becomes, how do you protect yourself and how do you minimize your risk? Because this is that fear, going back to where we started. How do you keep yourself at an arm's length distance? The same way that your lender doesn't want you related to the property you're buying. You don't want to buy from your brother or your sister or your parent. You want to be arm's length related. So how do we do that? How do we give ourselves isolation and protection? Well, property manager's one, obviously. But one of our biggest pieces is insurance. And this goes back to that question of, do you buy in your personal name? Do you buy in your LLC? Because most of the answer that you're going to get depends on who you talk to. You've got attorneys that are conservative. You've got attorneys that understand, like my attorney does, that the bottom line is if you're going to get sued, you're going to get sued. And the more you have to protect, the more you have to go after, the more likely you are to get sued. And this is why insurance is so vastly important. I use NREIG. I strongly recommend NREIG. You can also check with your homeowner's insurance. If you only have like 1 to 4 rentals, you can often just add it to your homeowner's policy really affordably. The reason I like NREIG is it's one monthly bulk reporting policy, really easy to do, especially as you grow your portfolio. They have the cheapest prices that I've seen. They offer service line coverage, which covers your plumbing, gas, water lines. I use that type of coverage all the time. I file claims all the time on my older homes. It's great, $500 deductible. It's only a few bucks a month, worth every penny. Vacancy and renovation are easier to update. They can handle the vacancy and renovation policies right within that portal instead of having to go get very expensive third-party vacancy and renovation policies. Liability insurance, this is a big one. Going back to vacancy too, I want to make sure you understand that your policy, and most policies are going to cap at 60 days, some are 30, but most are 60. So if that property is sitting vacant more than 60 days, you're not covered. So you got to make sure that you get a renovation or an extended vacancy policy. And our EIG, once you call it vacant, you're covered. And then liability, you can get a 1 million, 2 million aggregate easy within our EIG. And I think they even offer higher than that. They have extra coverage options too. Again, that service line coverage is fantastic. And then they have the tenant protector plan. It essentially covers you for tenant caused negligent losses. And so you can buy that as a standalone option, or you can combine it with your regular property and liability coverage policy, your traditional real estate policy. So let's talk about the investment process, how you get started. You've done all your preparation. That's step one. So that's everything that we've been talking about here. Number two is your market selection. Everything we've been talking about here, your team selection, your model selection, your financial assets. So now we've made it up to number 6. We're at due diligence. Next, we're going to go to leveraging, property management, your 2 to 6 year sale or cash out process, and then your reinvestment process. So let's talk about what it is to purchase a property, what you should expect. Steps 1 to 4 are going to be where you prepare to begin your investment process. You're going to select your market, you're going to select your model, you're going to select your team. This is often the hardest part of the process. Step 5, you're going to get your funds in order, you're going to get pre-qualified, and you're going to pick a loan program. Usually this is a pretty easy process. Right now, it's a lot harder because rates are changing day to day and so are programs. And so we're constantly making different recommendations on a day-to-day basis between our top 2 products. Step 6, you're going to identify your property or your properties. You're going to negotiate terms and you're going to execute a contract. You're going to schedule your inspection. You're going to negotiate your repairs. Step 7, you're going to start that loan process. You're going to await your appraisal and your approval. And you're going to work with title for your survey and title commitment. And then finally, you're going to close on the property by sending the funds to the title company to close. Step 8, you're going to enter your property management agreement and you're going to start your 2 to 6 year model or whatever model you're following process on the property or properties purchased. Now, you might ask yourself, what is a mentorship? How do I get help with this? How do I get handheld? There's 2 ways, really 3 ways. One is you can educate yourself. There's tons of free education out there. We do that all the time. Step 2 is you can find a company that acts as an agent that's going to hold your hand, like what I do at Omni Realty. That's what my team does. They're amazing. They're all investors themselves. They're trained on investing. That is what they do. And then there's some people that want mentorships. And so we do have a mentorship program. It's pretty exclusive. We only limit it to a couple dozen people. We only have a few openings left. If that's something that you're interested in, you can certainly reach out to us. But the bottom line is get yourself a mentor, whether you're doing it for yourself, whether you're working with an agent that's going to mentor you, or whether you're looking for someone like Michael and me. Get yourself a mentor because that is super, super important. We do what we call elite. And this is something that I think you could translate into whoever you're working with, whether you're doing it yourself, whether you're working with an agent, whether maybe you are an agent yourself. This is the model that you want to follow. This is where real estate investing also pays back. You know, I'm a good example of that. I could be retired. My portfolio is large enough. I run large businesses. I don't have to do this. I do this because I absolutely love it. Why do I love it? It has transformed my life. It has transformed the lives of my friends and my family and my clients who become friends and family. We educate. It's important to learn everything you can so that you can make the best decisions for your financial future. That's not just in real estate, guys. That's in your entire financial journey because the government, our schools, they are not doing it. They are certainly not educating our kids in this. Leveraging. I'm not just talking about financing here, guys. I'm talking about how you can leverage people, systems, and places to help you. Your itinerary, the who, the where, the when, the why, and the how. The first thing I ask every person that I work with is, why are you doing this? If their answer is to get rich, that's not an answer. Why are you doing this? Really, really important. My why started with my adopted kids. My why started with knowing that I had one that was going to need help the rest of her life. I now have 4 adopted kids. We don't know what the world's going to do. We don't know where we're going to be. But what I know is that we have a responsibility as humans, as people, to help those around us. That's my why. It's always been my why. Teach. What guidance can you provide others? You might think that you are just a beginner, but I promise you, you have something to offer to other investors. Maybe your failures are what you have to offer. Maybe a real estate deal that you did bad is the best that you can offer. Maybe it's a win that you can offer to motivate someone else who can transform their life with the power of investing. And then endure. What preparations can you take to make sure that you are resilient no matter what's happening around you? This is a great, great thing right now. Is how do we endure no matter what rates are doing, no matter what our political climate is doing, no matter what wars are happening in Europe? How do we endure? So again, we offer mentorships. There's tons of other mentorship opportunities for everyone, not just with us, but with other people, tons of free education online. One of the great ways that you can stay on touch of all our free education is to text us, join our texting list. Or of course, again, you can join our mailing list. I'd love to see you in person October 10th if you're local to DFW. We're going to be talking about what passive investing is and what opportunities we have for passive investing. I do offer one-on-one consultations. They're $125 and we do a deep dive and come up with a plan. It's a great place to start. If you don't know what to do, you don't know where to begin, we can do a one-time consultation. You're not committing to anything bigger, not going to try to sell you on anything bigger. It is just to figure out where you are today and where we can get you. And those are all done by me personally. Our next class is going to be on leveraging. This is going to be a big one. You can register. That's October 5th from 7 to 8 Central. And then after that, we have the backbone of profitable investments. This is going to be talking about the tenancy process and property management, doubling your portfolio. That's on November 2nd. We have our virtual property bus tour where you can learn that one of the best things I think that this one's going to allow us to do is really deep dive into these areas and why these areas work, why these areas are what we select and what we focus on. And the really important piece of that is it's going to help you understand how to select areas, not just here, but anywhere when you're scoping. Again, we've got 3 upcoming bus tours, October 28th, November 18th, and December 8th. We've got our live Wealth and Rentals conference going over what the market is doing and how you can use it to your advantage and the power of real estate investing. If you have not seen our Wealth and Rentals conference before, this will be updated, but it is an incredibly powerful experience to understand why we do what we do and how you can do it too. Please follow us on social media. Again, I'm posting daily. I post on Facebook, y'all. I'm going to be totally honest. My team posts on everything else. It's my content, but they take it from Facebook and they move it everywhere else. So just follow me on Facebook. That's the easiest one. Other than that, I thank you so much for watching, taking time out of your Sunday, giving me some grace for rescheduling Friday when I had no voice. And I look forward to seeing everyone hopefully October 10th, but if not, at our next class and beyond. Thank you so much for being a client or someone who's listening to us. And I hope you have a wonderful rest of your week. Thank you.